And I went to them like, what in the world are you doing? How were you prepared for this? What books were you reading? Where are you storing your cash? And they were doing the exact opposite I was doing. They weren't locking it up to their 59 and a half. They were putting in places that were going to be liquid so they had access to it. Also, they were creating passive income, and which is much different than trying to build your net worth and waiting until you're in your 60s to enjoy the money. And that's when I reread Rich Dad Poor Dad, which I'm sure a lot of your listeners have read. But I did something different because I had read it before, but this time I read it and took action.
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder, and CEO of Zana Investments, Tim Little. And on today's show, we have with us Cameron Christiansen and Anthony Faso. Anthony is a proud Army vet and self-described recovering CPA who worked at the world's largest accounting firm and served as CFO of a chain of restaurants. Cameron was a small business owner who was frustrated with investment solutions proposed by traditional finance advisors. They teamed up to become the founders and owners of Infinite Wealth Consultants, a firm that helps people grow their wealth without the roller coaster of the stock market by using the infinite banking system. Cameron and Anthony, welcome to the show.
Thanks, Tim. Thanks for having us.
Yeah, it's glad to be here.
Yeah, and I am excited to have you. Like I said, this is a first for me to have two guests at one time. So we're gonna see how it goes. But I gave everyone a very high level overview of your guys' backgrounds. But on this show, we really like to get into the details of how you got started on your journey. So please take us back to the beginning and tell us how you got to where you are today.
Yeah, thanks, Tim. I got started. The whole reason I got in this industry is my wife and I moved to Las Vegas, about 20, 21, 22 years ago now. But we moved here for school and I had an entrepreneurial spirit. I actually graduated and then started a small business right away. And I started making some money and I started looking at what I should be doing with it. And there I was, late 20s, trying to look for advice. And I reached out to the traditional advisors, the Charles Schwab's, JP Morgan's, whatever out there. And what was funny, Tim, is I got the same advice from every single one of them. And even at 27, I'm like, this is insane. Is this what people are doing? And I remember because every time I would ask one of those guys what I should be doing is they would tell me, hey, you should be doing this type of account. Duh. And I'd ask them when I'd have access to my money. And every single time it was, you can't touch it till you're 59 and a half. And I'm like, am I the only one that thinks this is insane? So what I did is I just kept continuing on with my business and stacking up cash. And really, it wasn't until I came across Nelson Nash's book, Becoming Your Own Banker, where as an entrepreneur, man, that book spoke to me. And I was like, this is exactly what I should be doing. And so I started doing it personally for myself. And then it wasn't several years later until I actually started introducing it to other business owners that I knew that really got me into this industry and became that resource for those other business owners. And here I am 15, 14 years later. And Anthony and I have been partners now for 3 years. So 4 years. Thank you. That's how we got here to Infinite Wealth.
Awesome, man. Yeah, and so I'll start with your story and then Anthony, we can go into yours. But
Yeah.
I just want to hit on that point of this. What do I do with my money? Because I think so many people run into that. And you're right, they get the same kind of generic advice. And I found myself in the same situation. I didn't have that much money, but when you have more than zero, if that's what you're used to having, then you still want to make sure you're doing the right things with it. I was telling you guys earlier, I was in the military. So after undergrad, I went back into the Army as an officer. And as an officer, you make a little bit more money.
Yeah.
And as I won't say kid, but as a man in your 20 somethings, it's more money than I had ever had before. And so I wanted to make sure I was doing the right things with it. And of course, I went to, I don't know, a CFP, I think it was. And they told me that the same exact things. They're like, you're doing great. You bought a house. You're contributing to your retirement account. You don't have high interest debt. Yeah, just keep doing what you're doing. And that's not really a very satisfying answer. And you don't
Not at
really
all.
see a huge light at the end of the tunnel until like you're, like you said, 59, and then you're just like stumbling down the tunnel. But you want something a little sooner. So I can definitely identify with what you're talking about there.
Absolutely. I remember just being in that transition. Same thing you just mentioned is you're growing up, right? You've got some cash and typically the first people you turn to is family. And I
Mhm.
remember turning to my parents and asking them, "Hey, what should I be doing?" And I love my parents but I looked at where they were and I'm like, "Man, I don't want to end up in that situation because I want more than that." And so that was the first dead end and then you start talking to friends and stuff and that never works out well and then you reach out to traditional advisors and it just never made sense to me.
Yeah, definitely same story on my side. And people probably know this who've listened to the podcast before, but my dad was a TV repairman, and my mom, who they were divorced, but she was on Social Security because of a back injury. So neither was in a position to give robust financial advice.
Yeah.
My dad, like I said, his job wound up disappearing because he was just a
Yeah.
casualty of technology, and sometimes that's the way it goes.
Mhm.
All right, Anthony, please give us your backstory.
I would say I was probably one of the people that were giving you and Cameron the advice, right? When I had my CPA firm, the secret sauce CPAs have are, oh, you owe 20 grand. Oh, why don't you put 100 grand over here? And then you don't owe the IRS anything. And because what most people incorrectly value their CPA is the amount of refund you got that year, right? But we really need to look at the overall picture. When we do these plans or these IRA or 401ks, I would say it's like you're going to McDonald's as a kid, or maybe you're going to McDonald's as an adult, right? You're excited to go, and man, it tastes good going down, right? It tastes good getting that tax deduction, right? Having that money working, but then eventually that's going to work down to your stomach, and you're going to get a stomach ache when you start watching the news and seeing what's happening to your account. And particularly for me, that's what happened in 2008. That was very eye opening to me. Not o- A lot of people lost a lot of money, but I was in a position where I got to see that firsthand. I got to see my clients who did everything they were supposed to do. They paid off their mortgage, they stayed out of debt, they maxed out their 401k, and now their 401k is a 201k. To and the worst part is to no fault of their own. It's one thing if you make some bad decisions and you're risky, you need to be responsible. But here, we're giving up that responsibility to third parties with Wall Street, and they're not going to take good care of our money. And that's when I realized that I had to do something different because we went back and looked. There's a recession literally every decade. We went back to the 1900s. Now, there wasn't this last decade, which I don't know, makes me think that the next recession is going to be even worse. But what happened, I saw some of my clients that actually thrived during that time. They were the ones that were buying your neighbor's house for 50 cents on the dollar. And I went to them and like, what in the world are you doing? How were you prepared for this? What books were you reading? Where are you storing your cash? And they were doing the exact opposite I was doing. They weren't locking it up to their 59 and a half. They were putting in places that were going to be liquid so they had access to it. Also, they were creating passive income, and which is much different than trying to build your net worth and waiting until you're in your 60s to enjoy the money. And that's when I reread Rich Dad Poor Dad, which I'm sure a lot of your listeners have read. But I did something different because I had read it before, but this time I read it and took action. How many times have we read a book and it's, oh, this sounds great, and then we just put it down and we don't do anything for it. So I went on a journey to really focus on how can I protect my family? How can I create passive income to be more than our monthly expenses? And that's when I also got exposed to the infinite banking concept. And I read the book Becoming Your Own Banker, which again was very different. And so what I started doing is I incorporated both of those books to me personally. But then my clients were like, "Hey, Anthony, I don't trust Wall Street. What should I do?" So I'm like, this is what I'm doing. Why don't you read these books and I'll kind of guide you and tell you what I'm doing? And eventually I turned that into a business. But then I had my CPA firm, I had the infinite banking, and then somewhere off on the side, I had my family. And that the family is why I started my firm in the first place to spend more time with them. And so I got distracted. So I had to make a decision, very easy one. And I sold my firm probably about 10 or 12 years ago and was doing infinite banking full time. And then eventually Cameron and I merged. And because we felt there's an old saying that goes, you want to go fast, go by yourself. You want to go far, take somebody with you. So me and Cameron have joined forces, and it's been a blessing for us to work together and have that partnership and teach people how they can use the infinite banking concept to create passive income.
Yeah, and we're definitely going to get into the infinite banking system, learning more about what it is and how it can benefit folks. Wanted to hit on a couple of points from your story, though. The first thing that you mentioned that kind of hit me was when you were a CPA, you talked about how excited some people are to get their tax refund. And I'll tell you one of the first like mind blow things that happened to me when I was a little younger, probably in my 30s, when someone explained to me that getting a large tax refund just means that you gave a free loan to the government. And I was like,
Yeah.
it totally changed my perspective and was probably one of the only reasons I wound up hiring CPAs later, because I wanted to make sure that I was not paying more than I needed to in that interim, rather than all these people who are so excited to get this huge tax refund. And I'm like, that
Yeah.
just means you didn't have the money when you could have had the money. And there's so many things you can do with it if you're getting it then rather than waiting to the end of the year. And it
Yeah.
makes so little sense once you realize that. But when you're in the throes of it and you're just excited to get a check, just people don't think about it that way. I think a lot of times. And I don't know why.
Eh,
I would say one of the smartest things the government's ever done is create the federal tax withholding,
mhm.
because people don't even realize how much they're paying in tax. Oh, but what they do know is what their refund is. If they got that money, all their money, each paycheck, and at the end of the year or maybe end of the month, they wrote a check to the government for FICA and for income tax, I think we would have a whole new tax system.
Yeah. And I don't want to, on a rant
Yeah.
about the tax system. I feel like we're one of the only countries where we're like, is this how much I owe? And we present a number as if it's a guess. And then we see whether the government tells us we're right or wrong, which just
Yeah.
seems like a ludicrous system in general, but it is
Yeah,
what it
it
is.
is.
Uh,
Another piece that you talked about was 2008, which obviously was so impactful for so many people. I count myself lucky because I had looked into real estate prior to 2008.
Mm,
Life got in the way and I didn't have time to start investing in real estate the way I wanted to. And I would have been probably in the single family market. So I probably would have lost everything I had. I started in real estate the first time I read Rich Dad Poor Dad, like you were talking about,
mhm.
but I didn't take action. And I don't think I was in the right place in my life to take action. But then post 2008, I was in the same position that a lot of, it sounds like your clients were in, where I lost 50% of my 401k at the time, my TSP. Luckily, again, I was relatively young. So it just went from 40,000 to 20,000, which hurts a lot when you're
Yeah.
in your 30s. But in the grand scheme of things, you still got plenty of time to
Yeah.
make it back, which is good. But then, like you said, I read Rich Dad, Poor Dad way later, and I was in a different place in my life where I had more disposable income. My priorities had shifted, and I was ready to take action. And that's where I got started in real estate was that second time because I was like, all right, now I'm going to do something about it. So I think that's a key point that sometimes we get information that's super useful, actionable, but we don't do anything at that time, either because we're not in the right place or maybe we don't have the resources. But if we revisit that important information later in
Mhm.
life, we might be in a place where we're able to apply it and make a huge difference.
Totally
Well
agree.
said. Yeah. Couldn't agree more. I was taking
Yeah.
notes on when you were talking, Tim. That's
No,
good.
I haven't
Yeah.
seen that before.
Yeah.
All right. So let's get into infinite banking because you brought that up.
Let's do
And
it.
just to create a baseline for the listeners, I have had previous guests who were providers, practitioners of infinite banking system, and I've heard it called different things before too. As a baseline, please help the listeners understand exactly what the infinite banking system is.
Perfect. This is our bread and butter. Now, what we found is with most, infinite banking is not that complicated,
Yeah.
but the tendency, agents and even myself, I'm a recovering CPA, so I can get real down into the weeds. But if we really look at a high level, what we found is most of our investors are putting money aside somewhere as so they can build up money to buy whatever their asset of choice is. And typically they're looking for somewhere where it's safe and liquid. They store the money there, and then when an opportunity comes, they withdraw the money and buy the asset. And they're typically using a bank for that function. And then they withdraw the money and buy the asset. Now, if it's a true asset, it's either going to produce cash flow or profits upon sale. When you get that, you have to put it somewhere. So you put it back in the bank. And maybe you take a little bit out for lifestyle, but typically you want to grow your assets. So we withdraw the money again and buy asset two. Now asset two produces cash flow. We put it back in the bank, and then we buy asset three. What we're really doing is we're using that bank as a temporary place to hold money in between opportunities. Now, all that we're really saying in the very simplest terms, instead of storing it in a bank that's safe and liquid, there's a place that is safer and just as liquid, going to earn a much higher rate of return, that has some level of asset protection. So if you get sued, they're not going to be able to attach to this account. And more importantly, instead of withdrawing that money, we can leverage against it. So we never break the compound interest curve, meaning that money continues to grow even while we're using it. And the best product that can handle all those features is an infinite banking whole life policy. Now, I would tell you again, when I had my CPA firm, I had these life insurance guys knocking on my door all the time. They're trying to sell me this whole life. And I'm like, this just doesn't make sense. There's no cash value. I really don't need the death benefit. If I do, I just get some term insurance. Right. But the way we design this is very different, extremely different. In fact, you're going to have cash value immediately. And we design this and to minimize the death benefit to maximize the cash value. But all we're really saying is continue to do what you're doing. We're just saying instead of storing the money at a bank, store it inside a policy, and you're going to get the extra benefits. You're going to get a higher rate of return. Your money is going to be safer, but more importantly, that money is going to continue to grow even though you're using it. So we're never breaking the compound interest curve.
Yeah, and I think the biggest, I guess, mental block that
Yeah.
people have with this is the idea of that death benefit, right? Because they get focused on it because that's what they understand life insurance to be. Like, how
Yeah.
much will I get when I die? So when they see this and they're like, oh, okay, but death benefit isn't that much, or you're like, no, these are the benefits you should be focusing on. How do you get people over that hump to say, hey, I know this is what life insurance to be, but this is not that, and this is the point of our product.
Tim, that that question is what everybody has.
Mhm.
And typically what I'll do is I just share my story. I reference Nelson Nash's book. And just to add something to that is when I was buying my first house, our realtor actually gave me that book and said, if I would have read this when I was your age, it would have been the difference between millions of dollars. And I went home and I read that book. And what Anthony was just describing is actually very succinctly shown in Nelson's book on pages 44 and 45. So you had referenced reading a book and then taking action. If your listeners are out there and have not read Nelson Nash's book, grab Become Your Own Banker, read page 44, 45. And really what the entirety of that book did for me, Tim, is it introduced me to the whole side of cash value that you can use in this life insurance. Up until that point, everything that I had ever been told about insurance was buy term and invest the difference. Stay away from whole life. And then you read Nelson Nash's book and you're like, wait a second. There's a whole other side to this product that nobody's talking about, right? And if you can design it appropriately, you have all these advantages to it. And so, one, their concerns as far as the death benefit, it's certainly warranted. And a lot of times, right, somebody comes to us is there is a concern for having some sort of coverage. So most of the time, that's not too big of an obstacle. But man, when you get into it and you start looking at the way that the policy and the cash value performs, really the way that we try to coach clients into looking at this infinite banking is that it's not an investment. It's literally just the cash management tool. So you're just putting your money in there temporarily until you have an opportunity that comes up. And so it's not that we're trying to stack up a whole bunch of cash inside insurance policies, is that, man, that's the best holding account, either while we're accumulating cash or while we're transitioning into another investment.
Tim, what's interesting, if you look at the major banks, for example, this stat's a couple of years old, but Wells Fargo has over 18 billion in cash value life insurance. B of A has over 22 billion. Now, they have more money in cash value than they have in all their buildings and equipment. So you think they know something about life insurance that they're not sharing with us? And when you store that money in a bank, they're not putting it in the vault just waiting for Tim to come back and withdraw it. They're putting it to work. And one place they're putting it is in cash value life insurance. So one way we look at it is we're just cutting out the middleman. But to me, I'm very skeptical and I'm very analytical. And the theories are great, books are great, but I need to see the math. I need to see that this doing infinite banking is better than storing my money somewhere else. And that's part of what we do on our education process. We actually will prepare an illustration specifically for their situation, and we'll do the math. What if instead of putting the money in the policy, you put it in the bank? And then we compare both of those options with you buying an asset. And then we see at the end of the day who has more money, and more importantly, why.
Yeah. And I would imagine that it has become an easier argument to make as interest rates go up or as inflation goes up. I'm sorry. With inflation rising, then obviously your money is evaporating if it's just sitting in a bank, with most banks giving just paltry returns for what they're getting sitting in there. Now, you may have some high yield interest accounts that may get as high as 4%, which is fine, but not great if you have 6 to 9% inflation, which we've seen it's come down, but it's still relatively high. So I would think that with inflation being high, it's an easy argument to make to say, hey, look, you have this cash, instead of having it in a bank, you have it in here where you're at least breaking even, if not coming out a little bit on top compared to inflation. Oh, and you have all these other benefits, by the way.
Additionally, along that same line is that when you look at banks' instability, the instability of banks that has just gone through the roof over the years. And in times of crisis, banking institutions are one of the first ones to fail. And we're starting to see that right in the last 6 to 9 months. And people are reaching out to us saying, hey, I've got a bunch of cash in this bank. I need to move it. I got to get it somewhere that's going to be safer, more secure. And then you start to look, and the logical place is whole life insurance that's designed for cash.
Yeah. And talk a little bit more about the liquidity of it, but still being able to take advantage of the interest rates that are associated with the accounts. Because the difference being like I just talked about a high yield savings account, right? Okay. Yeah. You may get that 4% interest rate on that money, but as soon as you remove that money, you are no longer getting the interest on it. So talk to us a little bit how it's different within one of these accounts.
I'll go. Yeah, I surely have something to add. So what you're talking about right there is one of the pieces that I think Anthony and I just spend as much time as needed with clients when they come in, because the situation that you're going to get into when you're using an insurance policy is roughly the number that the policy is increasing by. Is we usually tell clients, hey, that policy is going to grow at around 4%. Again, that's tax free each year. When you borrow against the policy, the interest rate that you're going to be buying could be 5.5, right? 5.7, somewhere in there. And logically, Tim, that doesn't make sense. That sounds like it's a losing scenario. And so one of the things that we'll do is we'll just pull up a calculator and we'll show clients exactly why and how this is beneficial to them. And what you'll find in the long run is that man, you're going to end up with way more money because of that 4% that's compounding inside of that policy than you ever end up paying in interest when you're borrowing against it. And so that's probably the first hurdle, is to get people from thinking, man, I'm better off using cash. And that's what Nelson talks about in his book again, is he talks about, hey, we need to get in a collateralized position. And so that's the first thing that I would address with someone if they have that type of question.
Yeah. So you're talking about compounding on the original amount, whereas you're only getting charged interest on the amount that you're borrowing, for lack of a better word.
Correct.
Well, but even if you borrow the whole thing out, if there's a difference when you, whatever the balance is, let's say it's 100 grand, right? If it's compounding each year, the balance is increasing because it's compounding. When you have a loan, that's simple interest. And each year, the balance is getting smaller and smaller. So if we look at interest earned versus interest paid, you can earn more interest compounding than if you have a higher rate and it's simple. Now, and so again, we like to say that we do the math, and that's one thing that we do the math on. But also, when the way we use this, if you use your policy to buy an asset, you can deduct that interest. So as he's using 5.5, let's say you can deduct it, may depend on your tax bracket, maybe it's really costing you 4. So really it's the same rate, but we're going to earn even more money because the power of compounding. But in regards to inflation, that should be something that people should be worried about. But really, to us, the best way to fight inflation is to buy real assets,
Yeah.
right?
And
That's how we're going to solve the problem. But in between those assets, we got to store the money somewhere. So storing it in a policy is much more advantages than storing it in the bank.
yeah. And I think that's a great point. It's not to just let the money sit in there and get that interest rate. That's not the goal. It's just a place to store it until you invest it elsewhere where you're getting a better return on a real asset, which I think is a great segue. Can you give us like a case study on that nexus? Because this is a multifamily investing show, on how someone could potentially use the infinite banking system to passively invest in a syndication deal, for example.
I tell you, Tim, it's going to be very similar to what they're doing. But the only thing we're changing is where they're storing the cash. They stored it at a bank, they break the compound interest curve, and they're not earning anything on the money, but they are earning on the asset. We store the money inside a policy and borrow against it. So we never break the compound interest curve. So we're still earning on that money and we still have the assets. One thing I like to say is that this is my rewards credit card for investing. Now, Tim, do you use a rewards credit card?
I use several
Okay. Now, why do you use rewards credit card and just pay instead of paying cash?
because there are things that I'm going to buy anyway. So I might as well get rewarded for it. And I also have better legal protections for fraud, against fraud and things like that.
Ooh,
Oh,
great point.
great answer. If you can understand that, Tim, you can understand infinite banking. Because all what you said is, hey, I'm going to add one extra step and I get some extra benefits. So I view this, if I'm going to buy a syndication, I can't use my credit card. That would be great if I could, Tim. But instead of using my credit card, I use my policy. Instead of getting points, I'm getting uninterrupted compound interest and I'm getting some additional legal protection. So it's the same process.
Yeah, awesome. All right. So I guess some other questions that I think would probably come up are, okay, sounds great. What are the fees associated with it? Is there a setup fee and then continuous fees after that? Or is it just a one-time fee? How does that work?
Yeah, that's going to be policy design. And when you look at whole life insurance, there is two elements to it. There's one of it is going to be the insurance piece to it. And then there's also what's called a PUA rider. That's your cash portion that's going to go into it. When you look at that, the insurance piece or the base premium, that is like your traditional whole life insurance. So
Mhm.
somebody pays a premium or that part of the premium, and there's very little, if any, that shows up as cash value on that. That's really what goes to support the death benefit. And then what you've got is you got the PUA rider, which is going to be the cash portion that goes in the policy, essentially dollar for dollar. There's no fees or anything on that. That's really how you accelerate the funding on the policy. So if you look at that, what you'll see, Tim, is that if we look at like the first 3 or 4 years of a policy, the first year of the policy is where somebody's going to have the most cost. And most of the payment that goes to that base premium is going to be the cost. That's what's really going to pay for the death benefit. The second year, what you'll see is you see that cost reduce drastically. The third year, what is you see it go almost to nil. And by that fourth year, you should have 100% of what you put into that policy available for you in cash value. And then every year after that, you've just got this ever increasing kind of annual increase on cash as somebody pays a premium. And if somebody goes down this road, they do want to look at an illustration, make sure they understand those first few years. That's what Anthony and I refer to as a slow start. We are using an insurance policy. There is going to be an insurance cost. And what you want to do is you want to make sure that you manage that, keep that portion as little as you can, because what you're trying to do is get as much cash in there as possible.
Okay. And that makes sense. And I'm going to go back real quick to the syndication example. So for me as a syndicator operator, whatever you want to call me, it's basically, it doesn't look any different than any other money to me, right? Because there's different considerations associated with like self-directed IRAs
Mm.
and
Great
1031s,
point.
et cetera. But this should be just transparent to me if someone is using the infinite banking system to provide funds.
Yeah, it's not a qualified plan or an IRA or 4K. So it's not a government plan. So we don't have those restrictions. And you'd mentioned of the liquidity. I would say I bought an asset a couple months ago. I had the money wired to the escrow company same day.
Nice.
So it was just as liquid as if I had it, as if I had it in cash.
Yeah, and I think that's an important point for both the investor side and for the syndicator side doing the deal because they obviously want as little friction as possible
Yeah.
in being able to deploy people's money. Okay, so let's see, what else I was going to ask you something else. Oh yeah, you were talking about the time it takes to mature on these deals. And it sounded like it was only about 4 years. Because I was going to ask, is there certain age groups at which it stops making sense? But if 4 years is really the number, then you could feasibly start this at any age. Or do you have a cutoff where it probably doesn't make sense?
Just as Cameron said, it comes down to the design. So I'm working on a case now where somebody they're sitting on cash, right? Because they're scared of and they don't know where to put it. So we call that a kickstart. We're putting in a large lump sum in that first year. She's cash flowing in year two. So there are ways to shorten that window. However, we want people to come in with some realistic expectations, and we want them to be thinking more long term. So there are ways for us to shorten that slow start. As far as an age goes, where we found where it stops making sense is going to be the around 70 years old. And what is interesting, again, because we're using life insurance, and I wish there was another product that did the same thing that didn't have a death benefit, because that just distorts people's expectations of it. But we did the math. We took a 20-year-old, 40-year-old, and 60-year-old, and they both put in the same amount of premium in year one. Tim, who do you think had more cash value at year one? You,
I
what's your reaction? We got a 20-year-old and a 60-year-old and a 40-year-old. Who's going to have more cash value on day one?
logic would tell me, well, then nothing. I don't know. I always think I'm thinking long term, so I'm always like, oh, the youngest guy is going to fare out the best.
Well,
But
That's what
day
everybody
one,
thinks.
at day one, it's a little different because that person who's a higher earner may be able to have a plan that where they're able to invest more day one, and
well,
but none of them
you're,
have a cash value day one though.
we're both
They do.
putting in the same
Oh, okay.
premium. right? So this is
Okay.
before the plan. This is day one. Most people are going to think the 20-year-old, right? Because it's life insurance. They're younger, they're healthier. But year one, the 60-year-old had more cash. Now, and again, that's because of the design. We're not designing it for death benefit. We're designing it for cash value. Now, there is a death benefit component to it. The 20-year-old had a lot more death benefit than the 60-year-old, but we're not doing this for death benefit. We're doing it for cash value. We went to year 10, the 40-year-old was in first place, 60-year-old third, 20-year-old, so 6-year-old second. Still, the dollars was very minimal. Now, when we went back to 20 years old, I think the 40-year-old was in first,
Yeah.
right? And the 60-year-old was in third. But again, not by a large margin.
Yeah. And I think the point to take away from it, though, is like you talked about, there's ways that you can set up these plans to meet an individual's situation, right? Whether it's their age, how much income they can put towards it on a monthly basis or quarterly. I'm not sure how often they
Mhm.
contribute because they have to be able to maintain that. They could probably put extra,
Mhm.
is how I understand it, on top of whatever the minimum is. But I think the key point is someone might want to create like a huge cash balance very quickly. And so they have to still be careful not to make their contribution amount too high because they have to maintain that. But at the same time, they can have it lower, but pay more than the minimum. Can you clear
Yeah.
that up a
Yeah.
bit?
Yeah, absolutely. There's two things I want to touch on. One is what you're touching on there, and then I got another one. Is that just on the policy design and the access to cash value? Is a minute ago you'd mentioned that hey, there's no cash value on day one, right? I think that's what you said as Anthony was talking, and I want to address that. Is that that is like the old school, right? We call it that's your mama's whole life.
Okay.
That is not infinite banking. What we're doing in infinite banking is we're actually taking their products off the shelf that they normally sell and we're turning it on its head. We're trying to put as much cash and we're not concerned about the death benefit. So immediately our clients are funding a policy. And I would say that 70% and then some designs we can get up to maybe 90% is available immediately to borrow against. And so they're taking out loans at day 31. Right? So they're putting money in, they're turning around, they're taking it out and making that investment. That was the first one. The second one, remind me what I missed it. You were talking about.
It was basically the idea that, hey, I want to have that a considerable enough
Mm,
amount of money that I can use it for an investment and not have to wait 4 years. So I don't want to call it a catch up period, but
yeah, great.
can
Thank
we
you.
contribute more upfront in order to create that scenario?
Yeah, thank you for reminding me. Is we've got a design that we call a one and done, where you can literally dump in, as much as somebody would like into this design and you never have to make another payment.
Okay.
So we have clients that will exit an investment, right? They're flushed with cash. Boom, we put it into a one and done. And then 30 days later, we're rolling it right into the next investment. And now we've got all that compound interest and earnings and everything working for us from now until they pass. So that's going to be one design. Another design, a more traditional design, is that you're right, is we do have a ceiling that we need to abide by. But man, we've also got a low point that we can fund up to. And so there's a ton of flexibility in that funding that somebody can manage. And really, what we typically will call it, Tim, is we'll call it like the base portion of a policy. We'll call it their have to portion. And
Mhm.
that's the part that they do have to make a contribution every single year to keep that policy open. And additionally, not only because it's the cost in that first year or so, but also that's why we also want to manage that is we want to make sure that have to portion is really small. And then what we'll do is we'll lift up the want to, right? Which is, hey, I want to put in as much as I can this year. We'll lift that up as high as we can get it without causing any tax implications. And so there's a huge variable on flexibility for really an IBC policy that's designed appropriately.
I actually have two examples that fit exactly what you're saying. I'm working on this with a 68-year-old who's sitting on 100 grand or 150. I don't remember the exact amount. We're putting it in a one and done policy. And at the end of year one, I believe he has 96% If he was younger, it would actually be even higher. So when we get older, the one and done policies are typically a better fit because they have access to some capital that we
Mhm.
can put in. But then I also have a client who's going through a financial difficulty right now and is unable to make even his have to premium. And that's okay because we have enough cash value in the policy. We can use that to pay his premiums for many years.
Mm.
So while he's in this difficult time, he doesn't have to worry about making his premium. And when he gets out of this, now he can go back. And if he chooses to, he can make up all of the premiums he missed. And again, we would have never broken the compound interest curve. His money is going to be the same as if he had made all those payments timely.
Yeah, and I think those are some great illustrations of just some of the different scenarios that folks can find themselves in and how this structure still lends itself to solutions to those issues. You guys did mention tax implications, and so I just have to ask a question, and I
Yeah.
think the answer is no, but are there any special tax considerations associated with these plans?
Yes, and because it's life insurance, there's special tax benefits, which means the growth inside your policy is tax free. And what we use this, just like we mentioned, like you like to use the rewards credit card. The way we design this policy, you're going to use this to invest in your multifamily. And you're still going to do that. We're just going to run it through a policy. But what's going to happen at the end of the day, you still have all those assets you would have bought anyways. But now we have all this cash value inside your policy, which we can turn into tax-free cash flow in retirement. So once you put the money in, it'll never be taxed again. But also, this is a way that we can actually create tax deductions. Because a lot of times, tax deduction is a plus or minus. Like IRA, for example, deduction going in, we put the money in, it's growing tax free. When we use it, that interest is tax deductible. And particularly when we combine this with, I'm sure your listeners know, the tax advantages of investing in real estate, which is a great asset class. But when we combine those, I believe we're truly taking advantage of the tax code.
Yeah, basically you wind up like double and triple dipping in terms of tax benefits, which is awesome. So, gents, this has been some great nuggets. I hope people are taking notes on this conversation. But now we do need to move on to the turbo round.
Let's go.
Let's go.
All right. So I'm going to ask you guys 3 questions that I ask every guest that I have on my show. And I just ask you for a quick, honest answer.
Okay.
First question. What is one red flag every investor should look out for?
Red flag are fake teachers. So that goes with, and especially let's look at syndicators, or you're looking at somebody to do infinite banking. Are they just teaching it, or are they actually doing it themselves? There's so many people out there that read a book or took a class and are just regurgitating what they were taught, but a real teacher is doing it. They're going to know some of the downsides of what to watch out for syndications because they're doing it themselves. If you're looking for somebody to do infinite banking, we do infinite banking for investors. So we are investing ourselves. So we have that experience on both sides.
Yeah, you asked me that question, Tim, and the first thing that came to mind was more from an advisor point of view. Is a red flag for me is when I see people investing in something they don't know or understand. So first and foremost, you got to stay in your lane. You got to put the time and the effort into educating yourself on whatever you're going to be doing, whether it's multifamily, syndication, single family. Is there needs to be an education curve or some time spent on education before you ever write a check and put money into it?
And I'll just put those two together to say you need to educate yourself, and you can help identify those fake experts, whatever you want to call them, by asking questions. And if they're not willing or able to answer those questions, then that's probably a red flag right there. All right. Second question. What is a myth about this business that you would like to set straight?
I love this question. High commissions of whole life. That's probably one of the things And again, this ain't your mama's whole life. We're designing it very different. And the way that we design it, if you were to come to us and say, hey, I want to put in, let's just say 20 grand in premium, or you go to your financial advisor or your uncle who sells whole life, they're going to make almost 3 times as much in commissions than us. And that's because, again, that's just one of the other myths that there are out there in regards to whole life and infinite banking. That's why we have an online course, which we're going to give free access to here at the end, but you can look at it for yourself and see the math.
Anytime you bring up whole life insurance, Tim, is you get a lot of opinions and you get very little facts.
Right.
And so one of the myths that is around this industry is, man, you've got to get really good at being able to separate those two. I remember when I look back and I started putting my cash into whole life insurance, and I got bombarded with opinions, and I got bombarded with very little facts to support it. And I was stubborn enough to not listen to those opinions and just focus on the numbers and focus on the facts. And so that's really the way that we've approached the way that we educate clients is, hey, I'll give you my opinion on anything else, but infinite banking, I'm going to give you the facts. We're going to do the math for you.
Yeah, and I think as is often the case, you're probably getting those opinions from people who weren't actually doing or using the infinite banking system.
Oh, absolutely.
All right, guys, last question. What does success look like to you?
I tell you how I evaluate my success is the relationships I have with my wife and my kids. Money is a tool. It's a great tool, and I love using it, and I want a lot of tools. But at the end of the day, what really brings me happiness isn't the material things. It's having the relationships with the one I love.
Said Anthony, I couldn't agree more. Business is business. Anthony, I think one of the reasons that we've been successful as partners is that it's always family first, right? At the end of the day, you go home and you know what? I want to have healthy relationships with my wife, and I want to be there and setting the example for my kids. There's nothing more important than that.
Yeah, absolutely. I couldn't agree more. The name of my company is Zana, and I didn't just make that up. It comes from the names of my 2 daughters, Zara and Lana, so that I don't forget why I'm doing it. But also, like you were saying, in terms of setting that example, I want to be that example for them that I didn't have, not because my parents didn't want to provide that example of entrepreneurialism talking about. Obviously, they provided great examples for other things. To see me at least trying to grow a business and to become financially independent, I think that's really important for them to see that. So hopefully they'll catch a couple of lessons along the way.
Absolutely.
All right, guys. Hey, this has been awesome. I know that at least for me, you guys have provided a ton of value. I learned a lot, and I've dug into this topic a couple of times before, but I was still able to learn a lot of new things. So I really appreciate that. Please tell the guests how they can get a hold of you and if there's anything else that you'd like to share with them.
Yeah, I'll give them 2 resources. One is they can just go to our website, infinitewealthconsultants.com. We've got all the links to social media, and we've got a YouTube channel. There's a link there that has a ton of information if somebody's looking. But more specifically, if somebody's listened to us talk and wants to look at some of the videos where we actually do the math, we do have an online course. And so we'll give your listeners free access to that. And so if they go to this landing page, infinite.com/journey to multifamily millions, it's a little long. I'll email it to you, Tim, so you can put it in the show notes. But if they click on that, that'll take them in there. Once they get into the course, they're going to find some case studies. They're going to find a lot of the examples that we referenced today. There's not going to be anything salesy in there. There'll be a link in there that, hey, if somebody thinks this might be for them, feel free. You can click that, and then you'll end up on a meeting with Anthony or myself, and we can take it from there. But very easy, a lot of information in there for them to go check out.
Tim, I like to just add that if you want to learn more information, just like Cameron said, there's a discovery call, 15, 30 minutes, no salesy, answer your questions and see if this is a good fit for you. And I bet there's some listeners that are like, I don't know, I want to check this out. I don't really want to talk to these guys yet, but Cameron just gave a link to this free course that we're charging up to $500 for. If you're at all curious, take advantage of this link. There's IBC 101, and there's 3 videos in there that run time is less than 55 minutes, go find out for yourself. Maybe this isn't for you. This isn't for everybody. But if it is for you, it's better for you to learn now and start that compounding before you wait until the next time you're ready to take action.
Yeah, we certainly appreciate you sharing those resources with the listeners. You already provided a ton of value, and you're just stacking this on top of that. So that's awesome. Cameron, Anthony, thanks again. We'll definitely have all that information in the show notes. And I appreciate you coming on and look forward to continuing to see you do big things on your journey to millions.
Thanks, Tim.
Go make it a fantastic day.
All right, you too.